Good morning and welcome to another edition of the Main Management Weekly Market Note podcast. This is for the week ended August 8th, 2025. As usual, I'm Alex Varner, our head of research here at Main, alongside
James Maxwell, VP of Research.
Let's get into the week that we saw. Real quick on the Main thematic ETF, we do have our own offerings, and we just wanted to point out that this thematic future innovation product hit 5 stars on Morningstar. It's out of 166 funds in the U.S. global small mid-stock category based on our risk-adjusted returns as of 7/31. So if you have any interest in finding more about that, please get in touch with us.
Yep.
On the performance side, markets were broadly higher for the week ended August 8th. S&P up around, 2.4, I think, is what it ended up being, 2.5. Led on the sector side by Consumer Discretionary and InfoTech, and then laggards, healthcare and energy. Healthcare's still having a rough year. It's down 5.4 on the year, and with that negative reading, energy also tipped into the red, and then the only other sector in the red is consumer discretion, down 0.3% for the year. So as we look at the recession dashboard, not a ton of changes here from last week. Really, we mentioned a couple that happened at the end of July, but last week or so, not much has been altered on this guy, kind of middle of the road for the most part. The probably biggest data point this past week, and it was a pretty light week on the data front, but was the trade balance. This has been paid a little bit more attention to than kind of recent years, mostly because of the tariffs and trying to figure out what the effects are going to be of them. But this trade balance narrowed to a $60.2 billion deficit. That was smaller than forecasted and the smallest deficit since September of 2023. Imports and exports both dropped for the second month in a row. You've seen a little bit more volatility in these monthly readings. When the tariffs were announced, it immediately pulled forward a bunch of demand in like February and March, and now you've seen kind of an unwinding of that in April, May, and June readings. Between imports and exports. Imports more obvious than exports, at least given the fact that we are the ones imposing the tariffs. But worth noting that on the month-over-month basis, imports were down 3.7% and exports were down 0.5%. And for imports, the 6-month moving average is at its lowest level since November of 22. So that's definitely kind of a net, negative or slowdown on the imports. But again, it's a lot of distortions and just kind of giving back the demand that was pulled forward. Earlier this year.
One thing that I was reading over the weekend, this Goldman Sachs report came out discussing kind of where the tariff costs were being eaten, so to speak. But there's either the U.S. consumers in the form of inflation, U.S. businesses, like the businesses importing the goods in the form of margin compression, or the foreign producers in the form of cutting their own prices. And if you kind of look across those three categories, it seems like so far most of it has been eaten by the U.S. businesses through that margin compression. And then kind of second would be the consumers in the form of some, certain higher inflation in certain categories, not widespread, but again, in certain categories. And third being the foreign producers, which so far have not really cut prices, which was, I think, a hope that that was being kind of relied on, was that hey,
seems like a tall ask.
Yeah, they'll cut the prices and they'll pay for it. So far, that's not been the case largely. It seems, and kind of Goldman's forecast was businesses will raise their prices to keep their margins steadier, which will ultimately feed into the consumer eating more of that cost, which we'll talk about a bit later in terms of kind of inflation effects and all of that, but just something to keep an eye on.
Yeah, certainly some interesting dynamics there. On the goods and services side, goods makes up, both on imports and exports, make up far more than the services. Goods imports alone are 43% of total trade, and exports are 29%. So combined, you've got almost 75% of trade that is in goods, services the remaining 25%. But both goods and services kind of have been slowing as that tariff front running has unwound. Goods imports are down 2.9 year over year. That's the most negative since October of 23. Exports are still up 3.3, and then services imports and exports decelerated to 4.5 and 3.3 respectively. So those are still net positive year over year, but you've really seen an unwind in that goods import side Again, kind of on the
Tariff side,
distortions. Yeah. So moving into the productivity, we saw the estimate for Q2 productivity rebounded back to plus 2.4% quarter over quarter. It's good to see that rebound because Q1 was down 1.8%. And that rise in Q2 was driven by a 3.7% increase in output. That's the best since Q3 of 2023. Hours worked rose 1.3%. That's the best since Q1 of 23. So you're seeing solid increases in those two figures, and the productivity's output per unit at a time. So when you have output increase or rise more than hours worked, you get better productivity.
Yep.
Unit labor costs slowed to 1.6 quarter over quarter, which is slightly above forecast for a 1.5 reading. Those are kind of more indicative of inflationary, but they are, muddling along, 1.5 or so, no 1.6. Not a huge concern there. And then on the right, we know, the manufacturing sector is 11, 12, 13% of the economy, but it is something worth looking at. And you've seen 5 straight quarter over quarter increases, which is a pretty solid streak. It's longer than one we've had in quite a while. And that's brought that 20 quarter, that's 5 years, rolling average to its highest level since Q3 of 2014. So maybe you're seeing some decent, increases in the, start of a trend in the manufacturing productivity side. On the 20 quarter average, speaking of that, we look at the 20 quarter average rolling 5 years because it gives you a little bit longer trend line. It kind of cancels out some of the noise. But again, you can see these post-pandemic effects are still unwinding, where we've just now rolled off Q1 and Q2 of 2020, which were huge distortions. And that dropped the 20 quarter average to 1.15. That's the lowest since Q4 of 18. But again, this is the sort of thing where, we're looking at it and you say, okay, it is now kind of below that trend line, but hopefully we're going to see a rebound, given the distortions rolling off, it'll resume its upward, kind of trajectory, we hope. And then as AI kind of rolls out. And the key here also is looking at that PCE number, that core PCE, where that's been elevated and above productivity, which you don't love to see, but it's clearly in a downtrend there. So it's you want productivity to hopefully kick up while that PCE continues to unwind.
One thing on the productivity side, this is a very kind of slow moving series, and that's why we look at the 20 quarter average, is because that basically 5 years, you really get to see the broader moves in something like productivity, because at the end of the day, productivity is kind of a funny calculation. Like you were mentioning earlier, it's looking at total output and then looking at total kind of hours worked or labor put into the output and saying, okay, well, how much more efficient are people or are workers with their time? Which is kind of a funny way to calculate something.
It's like, is what unit of productivity is like an email?
So it's a very rough way of looking at things. And within AI, there's obviously a lot of adoption, but I think it'll take some time to actually show up in the productivity figures where it'll increase output, because right now it's a personal productivity enhancer. It can write an email or look up something faster than you could, but maybe you weren't going to do that anyway, or it was something that it's harder to measure. I was gonna say the measurement is another concern here, is part of the issues and some of the concerns that have been raised about not only the data kind of quality, but also the measurement methods and how those need to be innovated upon in order to keep pace with the economy. So it's not as if, once we've defined unemployment, that's the way unemployment is going to be defined for the rest of time. Those changes have to be incorporated on the calculation methodology. And productivity is a perfect example of, if you're building AI and you're like, well, if it saved me time, but I didn't have an output. Like, it's easy to manufacture, easier on the manufacturing, because you can say, all right, we produced X widgets in this amount of time. Is the conveyor belt running faster or slower? Done and done. Whereas with humans, it's, I mean, if I send more emails, does that mean I'm more productive? Or if AI does 5 more searches, but there's no measurable output other than maybe my knowledge, that's a very challenging thing to measure. So how do you measure intelligence, and how does that relate to output? It's not, it's a very crude measure for something like AI.
So, we look at this, you want the productivity uptrend to resume. And again, you'd like to see it really consistently kind of push back above, at least in line with PCE. But that's kind of a longer term play, which is why we look at that 5 year. We also got Q2 household debt. household debt was up by $185 billion quarter over quarter in Q2. That's the biggest gain since Q3 of 24. You've seen some pretty solid gains since the pandemic. I mean, even since, going back to 14 or 15, just pretty solid, consistent household debt gains. It's now at 18.4 trillion, up 3.3 from a year ago. It's, also worth noting that it's up nearly 29% from the level it was during COVID, which was 14.3 trillion. And a lot of this is on mortgage debt, which is up 131 billion quarter over quarter, and credit card debt up 27 after credit card debt kind of dropped in Q1. But the mortgages, this stuff is measured on a dollar basis. Yep. So when you have higher priced homes and the median and average prices are at extremely elevated levels, it makes sense that this debt is going to be going up pretty solidly just because people are taking out more dollars to buy more expensive homes. The other side of this is obviously you want incomes to be increasing, and those have shown steady, solid increases. So I think the bigger concern that we'll move on to here is the delinquency. Are people able to service this debt? Because the absolute level, it's kind of like the U.S. debt ceiling, where you're like, at a certain point, does it really matter if it
has to? You have to show it on a relative to something.
Yeah.
The dollar amount, of course, it's going to go up over time.
Yeah, and especially inflation considerations, all that sort of stuff. So on the left, you see the breakdown. And again, mortgages are basically 70% of total debt, 12.9 trillion. But you do see on the right here, we show some delinquency stats. And the two concerning lines are kind of the red and the orange ones, which are hooking up. And that is 120-day and severely derogatory. Now, we do, you do want some perspective in that combined, these are still only like 2.8% of the total debt, but it's directionally a little worrisome. And you have that current number that has come down to 95.6%. That's the lowest since Q1 of 2020. Again, that is right in line. It's still above the long-term median. So I think we'll be maybe a little bit more concerned if we see that current level drop below that median in a meaningful way. But it is worth keeping an eye on that these kind of, most severe derogatory categories, like classifications, are moving higher. So it's definitely something we're watching.
And you're coming off a very low base kind of from post-COVID to now. There was partially because of the stimulus money, very forgiving forgiveness on the loans. There were it was just a lower delinquency rate in general. So you are moving off of that lower base, which is some of that, like the base effects.
And adding in the resumption of student loans that had been forgiven, I think some of those probably got lumped directly into derogatory categories, even if it was just a resumption of something that it wasn't that the person had missed payments because they've been forgiven. But if all of a sudden you say, oh, I don't have to pay my loan for 3 years, and then it comes back on, and they're like, oh, wait, you're now 3 years in arrears. And so we'll see on the categorization bit here. But, I think for the time being, things are kind of still moderating.
Something to keep an eye on.
Yeah. For factory orders, we saw June factory orders. They fell 4.8 month over month, which is the biggest drop since April of 2020. Again, these are clearly skewed by tariffs and pulled forward demand now unwinding, especially in the transports. Transports were up 48% in May, and then they dropped 22% in June. So you're seeing some really skewed figures. And the transports also tend to be a little bit more volatile because it's like aircraft. So you place like a one-time big order with Boeing, and that can spike
1 month,
and then it'll unwind because that order was placed in. It's just it's now in the queue. But you do see clearly a divergence here in the last couple of years on transports versus the overall kind of core or X transports. X transports, it was up 0.4 month over month. That's the best gain since November of 24. So again, kind of X those transports, things are chugging along decently well. Year over year, overall orders slowed to 5.6, while X transports accelerated to plus 1.3. And then we also got the consumer credit number here, which month over month was up $7.4 billion, accelerated from $5.1 billion in May, and above forecast for a $7 billion rise. A revolving credit, and this is like credit cards, stuff that kind of revolves, on a monthly basis, was down 1.1 billion, while non-revolving mortgages, et cetera, student loans were up 8.4 billion. So year over year, that total credit's up 0.5. Non-revolving is up 1.6. That's its highest since August of 23. And then revolving fell to minus 2.5. And that's its most negative since April of 2021. So I think this is kind of interesting to look at in juxtaposition with the household debt data, where you've got non-revolving credit is mortgages, and those are down, which means people aren't taking out the mortgages, but the dollar amount is kind of increasing. So it's a kind of funny juxtaposition, almost seemingly contradictory in a way. But again, it's year over year, so the comps are a big part of it. There's some noise. But I think it does speak to just the difficulty in the housing market right now that consumers and potential buyers are facing. So in summary, trade balance unexpectedly narrowed to $60.2 billion for the deficit, as both imports and exports continue to unwind from that tariff front running. Productivity rebounded to plus 2.4, while unit labor costs were up 1.6. Q2 household debt was up $185 billion quarter over quarter to a new all-time high. Delinquency, a little bit signs of deterioration there, which isn't ideal, but I think again, you want to see a little bit longer term before you kind of start jumping to conclusions. And then factory orders fell in June on transport, trade tariff volatility. And then finally, consumer credit accelerated in June, kind of indicating steady growth in borrowing, which is a good thing because that means consumers have an appetite to borrow and are confident that they will be able to pay it back. So that's all we've got for this week. Coming up, the CPI, inflation heavy. We get retail sales and industrial production as well, but CPI and PPI are going to be the two big data points for the week that we are about to head into. So as always, thank you for joining us here at Main Management, and hope you have a great rest of your week.
Great, thank you.